Well guys, I have to be honest. Tesla stock is one of the most, if not the most volatile large cap stock the stock market has ever seen. It also is probably the most commonly bought stock that falls into the category of, I bought it too high. I overpaid for Tesla stock. That is a devastating mistake to say the least. So let's talk about the right way to buy Tesla stock. And you can apply this to any stock in the stock market, not just Tesla. So even if you're not interested in Tesla stock, that's okay. You can apply this concept to any stock that you want to buy. And don't forget to check out the second channel down there that's off and rolling and already growing like gangbusters out there. If you want to hear about finance, retirement, entrepreneurship, and becoming financial free, a bunch of other stuff like that, just check out the pinned comment down there and check out that channel. So I'm actually going to give you 2 ways to buy Tesla stock, not just one. And both of these can be completely modified to kind of suit your needs. So the first way to buy Tesla stock is just to execute a simple DCA. Now, DCA means dollar cost averaging. For those of you guys that don't know what DCA is, it is statistically really hard to beat. Just a straight DCA into any stock. It's almost impossible to beat. So setting up a DCA is one of the best ways to buy Tesla stock because it kind of removes emotion. It removes a lot of the analysis. It removes a lot of the things that kind of, have us buying at that high point, right? You didn't buy high because you did this great analysis and you thought Tesla was, worth that much money. Most likely, if you were buying Tesla at 400 a year and a half ago, it was because of the hype run. Now, maybe you were DCAing, and we'll talk about that here in just a second, how that applies. But for the most part, you were feeling that FOMO feeling, and you were feeling like, I got to buy it because people were out there saying it was going to 700, then to 1,000 in the next year. And, all these I think somebody even had out there 1,500 or so, in the following year. I mean, it was just crazy, the price projections that were out there for Tesla in the short term. And nothing could have been further from the truth because all it did was just evoke emotions in you in regards to feeling that FOMO feeling like you're missing out. And if you don't buy Tesla now, you can never buy it ever. And what happened was you ended up paying that high price, overpaying for Tesla in the first place. And a simple DCA keeps those emotions completely out because you would have been buying it when it was at 100, when you would have been buying it when it was at 80, you would have just been consistently buying. So kind of an example of a simple DCA is just every pay period. Let's say you take $200, $500, $1,000, whatever the amount is out of your paycheck and you have it directed towards your investment account. And then whenever that money hits that investment account, you take whatever dollar amount you're going to allocate to Tesla stock. Let's just say it's $200, just for this example here. You take that $200 and you buy $200 worth of Tesla shares that day on a schedule. Every time you get paid, it goes from there, goes to your brokerage account, and then you allocate it to $200, to Tesla stock. You do that like clockwork every single time. So yeah, you're buying those highs at 400, but you were also buying the lows in the 80s and from the prior years. And you can see how over time, you just end up dollar cost averaging into a stock and you end up owning a whole lot of the stock. You were buying at the highs. You were also buying at the lows. And of course, some people modify that DCA even more. So over time, you end up with an average in a great stock that most investors can't touch, especially not traders. And it's just a hard strategy to beat. There's tons and tons of studies out there. Google them. I encourage you guys to go out there and do your research. DCAing into any stock, DCAing into the indexes, however you choose to do it, is an incredibly hard strategy to beat. I know a DCA is not this incredible brand new strategy, but I'm always surprised at how many people would really benefit from just doing a DCA into a stock, but yet they don't, and they try to play trading games, or they try to get in and out, or they try to just, buy on this chart, buy on that chart, all these other things like that. When a simple DCA, especially for somebody who doesn't have time to do a deep analysis, to do price targets, to get a valuation, a lot of other things like that, the best strategy is just simply to DCA in that stock, basically set it and forget it, and just let Tesla do what it's going to do over the next 5 to 10 years. And that way you don't have to worry about, am I going to buy it? Am I not going to buy it? When am I going to buy it? Oh, what if it goes up? What if it goes down? You're covered all the way around. You are absolutely in a power position there to kind of move on with you. Like maybe try to make more income so then you can continue to further your DCA. That right there would be a great strategy too. And what I would do if I'm going to execute it, just a simple DCA, well, great. That takes all my time that I would put in trying to figure out, where to enter the stock, what is fair value, and all sorts of other things like that. Instead of focusing on that, I can take my time over here and focus on building up my income, starting a side hustle, something else like that, which that's exactly what the second channel covers. So make sure you're checking that out if you want that sort of information. But just the normal DCA is really hard to beat, and that's why it's the first strategy I put out there to you guys, because it's really appropriate for a lot of people and really is easy to execute. Now, the second strategy we're going to talk about is a modified DCA, and I'm just going to give you guys the example of the exact one that I do here. I'll give you a couple of other examples from my group as well as to how you actually implement a modified DCA. There's a lot of different ways ways to do it. You can actually create your own way of doing it as well, just like a DCA, right? Normal DCA, you can choose the DCA in monthly or weekly or every time you get paid or whatever schedule you want to set out there for it. You can absolutely do that. And with this one right here, there's lots of different ways to modify it. So I'll give you a couple here so that way you kind of have a couple of examples that you can either use directly or you can deviate from and kind of keep, kind of create your own little scenario there that works right for you, that's right for you in your situation. So the first modified DCA example I'm going to give you guys is basically you execute a DCA, just like we just discussed in the first section. And then when you have a particular price where you feel that is a really, really sweet deal for that stock, whatever that price is, at that stage, you not only do your normal DCA, you have kind of a bonus little pool of money here that you dump additional money into. So basically it's kind of like, all right, I'm going to DCA as the stock is falling. Hey, it hits this level, continues to fall. I'm going to put more money in. So let's say you were DCAing $200, every time, every pay period, we'll say during that time. Well, hey, when that next pay period hits, I'm not only going to take that $200 and put it into Tesla stock, I'm also going to draw another $200 here from this pool and put it over into Tesla stock as well. So now I'm doing $400 worth of buys into Tesla stock. And as it continues to fall, if it continues to fall, I'm going to continue to execute that way, maybe even get heavier as it continues to fall, because Tesla's going to execute long term. You're very bullish on Tesla in the long term. So therefore, you're actually kind of doing a DCA, just you're picking up additional shares whenever it's cheaper, as opposed to, buying high, right? Putting all your money, going all in at one time when it's high. You're getting the advantage of the DCA, but also those lower prices as well. It's a great way to not only get the benefits of a DCA, but also be able to execute and kind of get a little bit of something extra whenever Wall Street gets really, really dumb, which as we saw last year, Wall Street got really dumb. So you would be buying a lot of shares of Tesla, in the 150s, the 120s, obviously 105 or 102 or whatever the heck it ended up getting down to. You would own a lot of shares in that time frame and not nearly as much up at the $400 mark whenever it was up there. So you kind of see how that kind of skews the data your way in regards to over the long run on a DCA. And the second type of modified DCA is the one that I use. And that basically means that I'm setting a valuation, then I'm setting price targets, and then I'm being patient and I'm waiting on those markers to actually hit the stock. Now, I agree, this is advanced. This is not easy. This, I have 20 plus years worth of experience doing this, so I feel very, very comfortable with doing valuations, with creating price targets within those valuations. So this is definitely an advanced method there. You need to be really, really comfortable with all that. And if you're not comfortable with all that, it's a lot harder to execute and you're going to make a lot more mistakes. And that's okay. A great stock over the long run covers all your mistakes. Trust me, I made all my mistakes, back in the early 2000s with Apple and a lot of stocks like that. And they've more than made up for my mistakes. It didn't matter that I bought it high and it fell 40% the next year. Hasn't mattered now because, obviously Apple has run up, thousands of percent since then. So it kind of makes up for those types of mistakes that I made very, very early on in my investing in regards to trying to execute this strategy. But essentially you start off with a valuation. So you get a fair value for the stock. And let's just say for Tesla, I'm going to say it's $250. And at that stage right there, bang, that's also then becomes my price target for that stock. And that here is just for this example here there. So let's say that's my price target. $250. It's also where I put fair value at. So when Tesla's at $300, I'm not buying it. I'm not buying until it hits that price target because stocks always tend to come back down to fair value over the long run. Now, this requires patience. This requires you being very, very comfortable not owning a stock that you really, really want to own, which may be where, hey, maybe a DCA is where you build up your initial position and then you use the modified DCA like I'm doing right now to kind of continue to add whenever stocks get on a further discount per se, basically adding bonus shares at that discounted rate. You can absolutely do it that way too. But for me, I set that price target and I wait till the stock falls. And then as it falls and hits that price target, at that stage, I start my DCA. And if it continues to fall, I continue to DCA down, DCA down, DCA down. And of course, as the stock, inevitably, Wall Street gets stupid, but then they stop being stupid. They come back around and then you're DCAing up until that point. And at that stage, I'm done buying again. Now, of course, you've got to redo your price targets and your valuations quarterly because, of course, quarterly earnings come out and that changes the valuation. And, of course, my position size, too, can also change the price target. So if I have the price target at, or let's say I have fair value, at $250, but I already have a full position in Tesla. So I'm not interested in buying it at fair value. I just want discount shares. At that stage, I would then move that price target down. Fair value is at $250. Price target gets moved down, we'll say $200 or anything under $200, then I'm willing to add more shares because those are bonus shares. I don't need any more at that stage. So I only want it whenever it's on a significant discount, whenever Wall Street gets stupid or they're thinking short term or Elon tweets something stupid or something of that nature. It always seems to happen. So you don't have to worry about it happening. It's going to happen sooner or later. And at that stage, that's right there's whenever I'm buying shares. But that is also how I avoid buying those highs, how I avoid buying those hype runs, because you can just see it. You just know, oh my gosh, now is it a good thing? Is it exciting? Of course, it's nice seeing my balance go up. Of course it is. But in general, I know that it's fool's gold, and I know that I don't want to buy at those levels. So for me, because I'm very comfortable being patient, I've been doing this long enough, it makes sense to me to just kind of wait until things get back to fair value. And then at that stage, I'll start buying. Now, again, that's not for everyone. That is not a beginner's method at all. Absolutely not. But for me, it is the way that I have chosen to do it over the long run. And I've done simple DCAs too. I've done all the different strategies here that we've talked about today, and every single one of them works. And don't overcomplicate this, guys. If all this seems overwhelming, it seems like it's too much, well, obviously you can join my group. We can teach you exactly how to do this in depth, but that may not be right for you too, or you may not have the time to allocate to that. So just do the simple DCA, guys. It's one of the most unbeatable strategies out there, regardless of what all the hedge funds and all the YouTubers and everybody getting in and out of stocks and everything else is telling you. It's not. DCA is one of the best strategies you can implement for your stocks. So I'd say start there first. So that right there may be the best strategy of all. If you want to learn exactly how to do all this step by step, everything we talked about that today through 5 courses, through live Q&As with me, through using our stock analyzer tool, through a ton of exclusive videos, several hundred now that we have out there you can go through. We have the best 6 and 7 and 8-figure Discord members out there to also help you out. There's just tons of information in there, too much to actually put here. So make sure you check out the pinned comment down there and see if a membership's right for you. And click this video here if you want to see exactly what I'm buying in this market. And click here to see my exact plan for this market. So thanks for watching, and we'll see you in the next one.